As we close in on tomorrow's Fed decision, our next guest says time to play defense. Joining us now, G Squared Private Wealth Chief Investment Officer Victoria Greene. It's good to see you. I mean, everybody's on the defensive side of the field. When is it time to play offense?
It's not yet. We got to wait a little bit longer. You know, everybody's expecting the Fed to continue to tighten. And until the Fed, like your other guest talked about, until they are ready to actually start slowing down and are dovish, I think this market is going to face some headwinds. And remember where we are in this global cycle. We haven't seen a bottom out yet. We can debate whether or not we're in a recession. I know we had that discussion a few weeks back, but it looks like we still have a lot of clouds and a slowdown coming up. Look at what FedEx warned us about. And you have to look at the companies that started reporting Q3 and really listen to what the CEOs are saying. So you have a tightening Fed, you have quantitative tightening, you have sticky inflation, and you have a global slowdown. And I just don't think it's the time to be aggressive yet.
Well, I mean, you were pushing for 100 basis points before. You've come off that now, right?
Well, the Twitter question of what should they do? They should do 100 because it would help them get in front of it. What will they do? They'll go 75. I think Powell did a really great job of ripping that pivot Band-Aid off after Jackson Hole, where there was all that commentary today about how he ripped up his speech and he had to come out more forceful. The biggest risk to the Fed is when there's a dislocation between expectations and what their paths are. So I feel like he's going out of his way to convince people that they're in it to win it. They're comparisons with Vockler, he's saying he doesn't want to start and stop. He wants to hike and stay there. I think all of these clues lead you that this is a committed Fed willing to sacrifice unemployment to make sure they get inflation under control.
Is there really dislocation, though? I mean, the bond market would argue otherwise, right? That seems to be in lockstep with where it thinks the Fed is going to be tomorrow. Now, you can make an argument that the stock market isn't quite there yet or not. It's not for me to make the argument, but I don't know about the dislocation argument you make.
Well, so I think parts of the bond market, yes, but you really haven't seen credit spreads blow out. You're seeing a little bit, but if you were to say this is the bond market under stress, it's not. It's not really showing the signals you'd usually see of a distressed bond market where you'd see credit spreads blow out. So yeah, you're seeing the 2-year almost at 4, the 10-year finally above 3.5, the highest we've seen in 12 to 15 years. And we'll see if this 3.5 becomes the next support and it moves up higher. But I do feel like the bond market isn't necessarily reflecting what we see in the stock market, mostly because spreads are still fairly low compared to the distress you're seeing in the stock market.
What about this call from Rubini that's going to get a lot of talk over the next 24 hours of a big decline in stocks because of a deeper recession and a harder landing than most expect?
We definitely expect a further downside. I don't think quite as far and as severe as he's predicting. We tend to never look in those extremes. We do think this is a more normal, typical recession between 9 to 12 months, and we'll see in a bear market, between 9 and 12 months, 25 to 30% on the downside. So you're looking maybe another 8 to 10%. That puts us around the 3,400. But I think you have to look at this market and understand we aren't exiting a recession. We're not exiting a bear market yet. We are entering the lows, and we will see the market bottom first. The market's a leading indicator. The rest of that's all lagging. So I do commend the Fed for being committed, but I do think there's this they're recognizing that they are going to have to put stress on the market, and that's going to be further downside on equities. But I'm not calling like an 08 blowout or 1929. I know that's what we're starting to harken back to, but those 45, 50% drops are very, very rare, and we just had one within the last 20 years. And if you look at the rhythm of the market between the early 2000s, the 2008, and then the 2020, you have seen stress on this market. So I see this as more typical bear market. We'll see earnings expectations come down. Everything's going to get terrible. People are going to capitulate and sell and then that's when the market will bottom.